Hey guys, Max and Aubrey here. Hope you're doing well. There's a lot of talk at the moment about the next big stock crash. Ultimately, there's loads and loads of articles being written about it. There's tons of information coming out on the internet all the time. Even, to the uninitiated, even the initiated trader, it can be a little bit overwhelming. You know, there's going to be analysts all over the world writing these reports and these reviews of the market performance, quotas and stuff, you know, all based on the gains of the stock markets. Now, when I say the stock markets, I'm not really talking about individual equities like Apple or Tesla stock. I'm actually talking about the US stock markets like the S&P 500, the US Dow Jones Industrial Index, things like the Nasdaq100, the US 100 tech stocks, the largest tech stocks. So those are the kind of stock markets I'm talking about. So essentially, when the coronavirus first took place, say March 2020, when it reached its peak, we saw approximately a 35% decline across the board in these stock markets. Everybody's waiting for the next crash, okay? It almost feels like an enigma of these gains in the stock markets at the moment. The stock markets have continued to rise against all odds. Every single month we're making new fresh highs, and you know, it's really powering up over there. It seriously is. The European stocks, I must admit, they're a little bit behind. You know, you think about the UK 100, think about the DAX index, for example. They're all sort of running behind at the moment. Their market correctives are out. I mean, the DAX is forming all-time highs, so that's fine, but the UK 100's not even at the previous highs yet, pre the coronavirus. Thinking about, you know, I just want to touch base back on the point that I just made about the analysts and stuff. All these analysts all over the world, they're all writing their reports, they're all writing these, or doing these different charting analysis and doing the fundamentals and thinking about where things are going over the course of the next couple of years, or the next 6 months to a couple of years, right? But the problem is with all these analysis, all analysis is subjective. You know, so one analyst will say one thing, another analyst will say another, something else. But the one thing that is a common theme across the entire lot is the fact that they are all talking about a stock crash. That's the one common theme here. We're all thinking it. What I say is by no means gospel, guys. Okay, I hope one thing at least that you can take from the videos that you've seen on this YouTube channel is that I am a down-to-earth guy. But the things that I can say is I wrote a report of my own, published article, and that was released maybe 2 years ago. And I was outlining that before 2025, there was going to be a potential meltdown. Now, I don't want this video for you guys to be all doom and gloom, okay? Because it's really not. It's not all doom and gloom. This is just think of this as like analysis based on facts, based on what we know. It's just cold hard facts. And the fact is, GDP has been increasing. Global GDP has been increasing against global debt. Repeatedly over and over again. So back in the 1980s boom, global GDP was about 44.4% of debt. The next one after that was about 45, I think. The next one after that was 47. The next one after that was 48. Something along those lines. What I'm talking about here is the fact that at every single point where GDP reached in between this 44 and this 48% margin, we saw an economic recession. We saw a massive stock crash. Then it's interesting that global GDP of debt at the moment is at a staggering level. It's about 20% higher than it ever has been. And we haven't yet seen that big recession. Everybody thought the recession was going to come from the coronavirus, right? Everybody did. And we are in a recession. Except the stock markets are supposed to be a very light-hearted reflection of economies around the world, right? So if you've got a healthy economy, if you've got a strong economy, the stock market's going to be booming. It's going to be doing well, right? Except for the fact that the stock markets at the moment are at all-time highs, and they're almost forming all-time highs every other day, it seems. So there's a large, and I mean a dramatically large, disparity between the information that we're given from the central banks in terms of their interest rate decision-making process, you know, the tightening of monetary policy. We're finally hearing a little bit about tapering measures, which is, coming at an alarmingly slow rate. I mean, the fact is, guys, if you think about the money printing that we've had, free money printing, we have had trillions, and I don't just mean this, now, we've had trillions of dollars over the course of the last year and a half into the economies. I'm not just talking about the US, I'm talking about pounds, I'm talking about dollars, all around the world, absolutely trillions of it. Where is that actually going to land? And most importantly, where is it going to end up? Because if it's anything we've learned through history, it's that the markets, the banks love clawing, or the governments love clawing back their money, right? They always claw back their money. They claw back their money from one source or another, one way or another, right? And they do this through different protocols, raising taxes, interest rates, exactly being one of the main ones, right? Then we get onto the point of raising interest rates. Why do reserve banks, or why do central banks raise interest rates? Well, they raise interest rates because of inflation. One of the major causes of inflation is tons and tons of money being flooded into the economy, brings up the prices of a product. Okay, so inflation then rises, right? So that's when things get inflated, when the prices rise of products, because there's so much more money in the economies. All of this stimulus that's been floating around at the moment because everybody's out of work and stuff, that's absolutely fine. People needed to be taken care of, okay, and that's what they thought, and that's what they saw fit. That's what they deemed necessary to do: flood the economies with loads and loads of money so that people can have incomes whilst they're not working and whilst they're locked down in their homes and stuff from the COVID thing. But what happens now when everybody is going back to work? Where is all of that money now gone? I believe, and this is honestly my 2 cents, okay? This is just my view, but I believe we could be entering into an age of hyperinflation. Now, I've been talking about this for quite a long time inside our trading room. I appreciate this is a bit of a late show for you guys here who are not already part of the trading room, but I really have been, blowing the whistle of hyperinflation for a while inside the trading room and talking about this and expressing my views and my points on this. I believe with all that money now floating around the economies and everybody returning to work, that money needs to go somewhere, right? And at the moment, that money is, been rescuing people and helping businesses stay afloat and so on and so forth. But now that everything is starting to work again, now the big, huge global economic machine is finally switched back on, the government's going to come clawing that money back. Hyperinflation can be extremely deadly. How do banks tackle inflation? We know they tighten monetary policy. Now, the tightening of monetary policy begins with rising interest rates and hiking those interest rates. Now, if you think about investor confidence, let's say you're an investor, you have a small investment pot. Are you going to rather invest when you have a lot of confidence because interest rates are at all-time lows, because it's cheaper to invest? Of course you are. You're going to want to invest right down at the lows, aren't you? Think about it like a trade idea. Think about it like a normal FX market, stock market trade idea. You want to buy at the lows and you want to sell at the highs, right? It's general consensus. Think about that analogy, but then transferred over to the interest rates. Interest rates at all-time lows. Investors absolutely love that. It's an amazing opportunity because it's cheap to invest. But if we're entering into this potential age of hyperinflation, and those interest rates are going to be rising, and they're going to be rising to levels that we haven't seen in our lifetimes. Possibly in my lifetime, I don't know. I'm 31 years old, maybe when I was like a baby, but that's about it, right? Okay, so not in my adult lifetime, not even in my teenage lifetime, okay, have we seen interest rates as high as I believe they possibly could go. If you think about the risk on, risk off markets, okay, I can't possibly have enough time to go into risk on and risk off right now as well. But let's say, for example, the investors, they are really confident because interest rates are at all-time lows and it's cheap to invest. Those interest rates rise to tackle hyperinflation. That's going to be very bad for what? Investor confidence. So what are investors going to do? Investors are going to start pulling their funds and stop investing. They're just going to stop investing, aren't they? Even if you're not a fundamental genius, right? Even if you haven't studied economics, and even if half of this YouTube video sounded like absolute gibberish, what I want you guys to focus on moving forwards, okay, is I want you to try and take part in the central bank's interest rate decision press conferences. The press conferences can sometimes be a little bit drab. They can be a little bit, do I really have to sit there and listen to this mundane crap, right? But at the end of the day, guys, okay, those press conferences and the press statements and everything that goes around the information around the interest rate decisions, I want you to keep your ears wide open for any signs and news of inflation. Inflationary projections getting pushed up, which by the way have already started. Now I was talking about this months and months ago, 6 or 7 months ago. I was saying their inflationary projections are way too far down the line. They are going to be pushed up. You wait for it. They are going to be pushed up. United States, okay, inflationary projections end of 2022, then mid 2022, then the beginning of 2022. Okay, 3 different times now they've been brought up and up and up because the central banks know. Don't think they don't. They know what's coming. They know what they're going to have to do. The interest rates are going to start rising. Investor confidence is going to go downhill. It's going to become more expensive to invest. And the stock markets, that's where I personally believe the catalyst for the next big stock market crash are going to come from. Now, you may ask, but how much, Max? How much do you think the stock markets are going to crash? I honestly, at this stage, don't know. All I've got to ride on at the moment is some brief technical analysis, and I've been using what I've learned over the years in economics and fundamentals to really align my bias here. Now, if you asked me, if I would still continue to invest in the stock markets, of course, maybe not in an investment capacity, but I trade the stock markets twice a day, every single day, twice a day. I trade the markets, and most of the time I trade the markets long. So I'm still going long the markets, but they're only for very, very fractional periods of time. I'm only talking about a couple of hours, maybe 3 or 4 hours at most. Okay, so I'm not taking anything long term because I believe over the course of the next couple of years, we will see the stock markets have a serious crash. And then from that crash on, then that's going to be a really smart place that I'm going to think about purchasing an investment opportunity in the stock market. Obviously, I can't give investment advice or anything like that. Okay, so this is just my personal view. But seriously, guys, take heed of what I've said here. Thinking about inflation, okay, as being the catalyst for the next big stock market crash. Thinking about global GDP % ratio to debt, global debt, and how extremely high it is. So guys, I'm going to wrap this video up there. I hope you've enjoyed this video on inflation in the stocks and kind of my view, if you like, of the next big thing happening in the stock market. Obviously, this is just my 2 cents. It could be a bunch of rubbish. I'm not entirely sure. Before, I've made some pretty good calls inside our trading room. They seem to have worked out pretty damn well in the past. So I'm just going to continue running the theme that I've been running in the past. But hopefully I've built up a little bit of an image of myself now. I don't pretend to be anything I'm not. So just please take the information with a pinch of salt. Really what I would do is I'd be super keen for you guys. Head out there. Look for the central bank information. Keep your eyes peeled on anything to do with inflationary data. Look at their inflationary projections. Look at them being pushed forward. Think about the concerns they have around inflation, any news of potential future rate hikes. Okay, and this isn't going to happen just with one country. This is going to be a global thing. Okay, so this is going to be each of the central banks raising their rates at the same time. Okay, so get ready for that, guys, because when the rates hike, when inflation becomes a problem of today, those stock markets, I believe, will be taking a dive. Alright, so guys, I'm going to wrap things up there. Hope you've enjoyed today's YouTube video. Listen, guys, as well, don't forget to subscribe to this channel. I'm really working at getting some good information out to you guys and good, bi-weekly videos. And by all means, please come and check out the How to Trade trading room for all of the educational content in there. Remember, the courses are absolutely amazing. So please come and join in. Take care, guys. Good luck, and above all else, trade safe. I'll see you soon.